For this next part, let's dig into the qualitative characteristics of accounting information. Now, this is still introductory type information. It's not something you're going to necessarily need to know to do journal entries, post to the ledgers, do all of the accounting processes. But it's helpful to understand what's going on here. The idea is that accountants prepare information for users, external or internal users, and this information has to have certain qualities to be of any use. And overall, the idea here is that this information should have decision usefulness, which is just another way of saying it's useful in making decisions. There are two main branches of characteristics that are important for this information to be useful in making decisions. First of all, it needs to be relevant information, relevant to the decision at hand. In order to be relevant, there are three things that come into play. First of all, it should either have predictive value, which basically means a user can take this information and use it to try to predict what's going to happen in the future. So it can have predictive value. And then on the other side, you need feedback value. This is after you've made a prediction and after the year has passed. Now you need something to prove whether or not that prediction was right or wrong so you can tweak it going forward. And third, it has to have timeliness to be relevant. And the idea here is that, we're making a prediction ahead of time, but if that information doesn't come out soon enough, then by the time we get the information, it's too late. So it needs to be timely in order for us to make decisions about how to invest or how to run the company, depending on which type of user we are. So relevance is important, but it also needs to be reliable. And in order to be reliable, there are a couple of different things it needs. Verifiability, first of all. The idea here is that if this information is not transparent at all, if we have no way of knowing whether or not it's true or accurate, then it's not reliable and we're not going to be able to use it to make a decision. It should be neutral, objective. In other words, it's a fact, as close to a fact as we can get. It's not somebody's biased opinion, for example. And then the other thing here, representational faithfulness. This is really just another word for reliability. It should faithfully represent what it purports to represent. So that's what we have there. The next section I wanted to get into is the types of financial statements that we're going to talk about throughout the course. This is just an overview at this point, but we're going to dig into these four and we'll see some high-level examples. So here we have the income statement. By the way, this is in the proper order that you would see it prepared by a company. You need the income statement first, and this shows our revenues and expenses, as we'll see in a little bit. Then part of that flows over to the statement of owner's equity, statement of stockholders' equity, a lot of different terms for this. Sometimes you'll just see a component of this statement known as the retained earnings statement. Again, all of these we'll see later on. The balance sheet, which shows assets, liabilities, and equity items. And then the statement of cash flows. So those are our four statements. Let's talk about the income statement first. The income statement, as I said, shows our revenues through the period, the expenses for that period, and then we subtract the two to hopefully get a positive amount, which is net income. If it happens to be negative, which means we had more expenses than revenues, this would be a net loss instead. Whatever it ends up being, this amount carries forward to the retained earnings statement, as we'll see in just a bit. We'll see why. Now, this is a period of time. It shows the revenues and expenses for a month or a quarter or a year, however you're building the statement. It's not the entire life of the company for the revenues and expenses. You need a period, whatever period you're stating. Here's an example. This is for the year ending December 31st, 2016, a little bit older year there, but we see a few revenues. There's a subtotal for the total revenues, and then we see all the expenses and total expenses. And notice we had $74,250 more in revenues than we did in expenses. So that's a positive net income. Now we're going to see how that 74,000 flows forward in just a bit. The statement of owner's equity, or the statement of changes in owner's equity, shows how the various components of owner's equity have changed throughout the period. We have two main components of owner's equity. The first is our paid-in capital or contributed capital, and this represents the different types of stock the company has. And again, we're going to see a few examples there. We'll also have a chapter later on where we dig into this particular component in much more detail. But we have all the paid-in capital. Then we have the earned capital or retained earnings. Now this is basically all the capital that the company has been able to earn because of all the financing that it had. So we take the retained earnings from the prior period, we add in the net income from this period, subtract out any dividends that were paid out, and that gives us our final retained earnings balance for this year. So you'll notice that this is the reason we had to do the income statement first, because net income impacts this owner's equity statement. This one also is a period of time. And here's a pretty basic example of it. You start with a row that has all of your beginning balances. Here we had common stock. You might even have preferred stock. Again, those terms will come up later. Now there's something called additional paid-in capital in excess of par. It's a little bit early to talk about this, but it's also a capital account. Retained earnings. And then again, it's a little early to talk about treasury stock, but basically this means the company has bought back their own stock from the market and they're temporarily holding it. So the point is you have your beginning balances and you have certain things that increase or decrease one or more of these account types. And you get your ending balances. Now this total amount right here, the grand total, 1.1 million, that moves over to the balance sheet, as we'll see here with total equity. In fact, the three components actually move over to the balance sheet as well. The balance sheet is an unusual statement because it's a point in time compared with the other ones that were periods of time. So that's the main difference there. But this brings up our accounting equation, which is going to be very important in the next chapter. And it's really important throughout all of accounting. This is the fundamental equation that sets up the double entry accounting system. But it's basically assets, the items that the company owns, the resources they have, that equals the liabilities plus equity items. In other words, who do they owe money to? Do they owe money to the creditors that they've borrowed money for or from? Or do they owe the money eventually back to the owners? Do the owners have a claim in those assets? This equation absolutely has no exception to it. This must remain in balance throughout every single transaction we make. And this balance sheet serves a couple purposes. First of all, it obviously shows the balance, the ending balance of every single account the company has, but it also proves that yes, total assets, 1.174 million, equals total liabilities plus total equity, the 1.174 million again. So that's important. This is a point in time, so it's not a period. It's not showing these are balances throughout a month or a year. It's as of this point, based on every single thing that's happened to this company throughout its entire life. Here's where we stand today. Now the statement of cash flows, I guess first let me back up here. We had the cash balance of $60,000. That was the ending balance. I just want to show you down here at the end of the statement of cash flows, you have $60,000 there as well. You're eventually going to reconcile to this number. But the statement of cash flows, the purpose is to show how true cash has changed hands. Has it increased? Has it decreased? And why? We break it into three different activities: operating activities, investing activities, financing activities. We're going to see what each of these are in later chapters. Just to give you a quick hit, operating activities are the core operations of the company. It's what they're normally in business to do. They're collecting money from customers, they're paying off some regular operating bills. That's generally what that is. Notice you have some inflows, some outflows. Makes sense. You'll have a subtotal here. We have investing activities, which this could be them actually investing in stocks or bonds, which makes sense, or selling those investments. But it could also be the purchase or sale of long term assets that the company is using to run their company. Financing activities, basically, where did they obtain the financing? Did they issue stock? Did they borrow money? All of that. Overall, you're going to get a net increase or decrease in cash from all three categories. If it's positive, you'll add that to the beginning cash balance, and that'll give you the ending cash balance. Now, that balance sheet we just talked briefly about, I want to point something out here that we're going to expand that accounting equation to start our discussion of the normal balances of accounts. Now, we said assets must equal liabilities plus owner's equity. Of course, you have several different types of assets. In fact, we'll see a few examples in the next one. We'll see some various liability examples. And then owner's equity can be broken out into different components. So we already said we had paid-in capital and retained earnings. Retained earnings can be broken out even further. Obviously, we start with beginning retained earnings, but then it's impacted by dividends, revenues, and expenses. So what this boils down to, if we look at the bottom breakout for every account type, we have assets, we have liabilities, but then owner's equity, we said we have paid in capital. Retained earnings can be broken out, and it's impacted by dividends, revenues, and expenses. What this gives us is basically 6 core account classifications: assets, liabilities, paid in capital, and then the different components of retained earnings: revenues, expenses, and dividends. We just said retained earnings is kind of a combination of these last 3. So even though you could call that an account, it is an account in and of itself, we're not going to list that in our core account classifications. Now, as far as assets, there are a variety of them. I've just listed some simple ones here: cash, accounts receivables, supplies, inventory, office equipment, things the company owns and can use in their operations. Liabilities, we have accounts payable, basically any payable type item. It's something they owe. We'll talk about the difference between accounts and notes payables in later chapters. It's generally the level of formality and the length of time they are outstanding. Salaries, payables you owe to your employees. And this takes us to the end of our Week 1, Module 1 discussion for this course. We're going to continue on next week talking about the mechanics of accounting, and we'll talk about debits and credits, journal entries, posting, and all of that. So hopefully this has helped to build up some of that expertise to prepare us for that next chapter. Thank you for your time.